Good afternoon, everybody, and welcome to today's webinar, How to Invest Passively in Short-Term Real Estate Flips Using a Self-Directed IRA. The voice you're hearing today is still Erica Figueredo, the marketing specialist here. Unfortunately, no webcam, but we are back in the office um, temporarily and only on a one day a week basis, but we are back. You'll see Brittany, who's in our conference room, and we have Steve Feldman, who is part of the Feldman Property Partners. So we've got an exciting presentation for you guys today, but as usual, I'll go through some housekeeping items and then give the speakers the ability to introduce themselves and, of course, our very necessary disclaimer. So today's session is obviously being recorded for anyone that didn't get a chance to join or for anyone that wants to watch it again later. So everyone is going to be placed on a listen-only mode. And if you guys look to the right-hand side of your screen, you should see your go-to webinar control panel. And the two tabs that I would like you guys to focus on is the questions tab and the chat tab. So the questions tab is pretty obvious. That's where you're going to ask your questions. So if at all throughout the presentation you have a question, just pop it in there and we'll try to get to it as it's relevant. Otherwise, we'll hold it for the end. And then we have the chat tab. So that's where I'd like you guys to spend some time, introduce yourselves, obviously get acquainted with the audience. You guys can chat the entire audience or just one of us. So it's a great way for us to get to know you and for you to get to know other audience members. So without further ado, our very necessary disclaimer, today's webinar is for educational purposes only. And if you feel that this investment might be something that you're interested in, we encourage you to discuss that with your financial and or tax professionals. So I'll hand the floor over to Brittany and Steve to introduce themselves, and then we'll get today's conversation going. Brittany?
Hi, everyone. Good to see you again. For those of you who have not joined us before, my name is Brittany Melville, and I am the Director of Marketing and Sales here at Next Generation. I've been with the company over 4 years now. We're based out of the New Jersey area, and I have over 13 years of experience in marketing and sales for a number of different industries. But obviously today we're going to be focusing on the financial services side of things. So I am responsible for leading the team that does all of our educational outreach and onboards new investors. So if this is something that you think might be a fit for you and you've not done this before, then our team would be happy to guide you through that process. Just a couple little personal notes, since we're talking about real estate today. I'm by no means an expert. Steve is the expert, so we want to hear from him. But I do own a rental property here by the Jersey Shore. I live in, I guess we would call it North Jersey, with my husband, and I have a 1-year-old son. And for fun, I play piano. I enjoy reading and traveling when it was possible. And a new hobby I've gotten into during the pandemic is doing some mindfulness meditation. So with that, I will let Steve introduce himself.
Hi, thanks, Brittany. Thank you, Erica, for the opportunity, both of you today. My name is Steve Feldman. I live here in Manhattan, originally from Boston. So if anybody has difficulty in understanding me in the New York and New Jersey market, I understand, forgive me. But I did marry a lovely lady from Brooklyn, so I get the pressure both ways, and I'm picking up some New York dialect here and there. I started investing in the late '80s, and it was in New Jersey, ironically, because that was the only place where I could find a partner at that time that had the money, the time, the credit to actually get started with me. I just combined and made a partnership because in those years, I didn't have those things. I was coming off different jobs in the executive field or the sales field here in New York, but I wanted to be on my own. I wanted to be in real estate, and I found a young lady from Brooklyn who wanted the benefits of real estate. We both took various courses that were on TV all the time in those days, and we wound up in New Jersey because she had grown up there. Then married, moved to Chicago. Got divorced after many years and moved back to Brooklyn Heights. And she said, Steve, I'll partner up with you. We can do this together, but I'd like to do it in Newark and Irvington, where I grew up. So that's why my entire career, starting in about 1989, 1990, full time, has all my deals have been central and northern New Jersey, because I got started there. And once I had a deal or two deals, it just made sense to have a sphere of influence and not be driving east, west, north, and south, but go to one place. And 389 deals later, New Jersey is my marketplace. And although I've managed my own portfolio for 10 or 12 years during the 90s and early 2000s, I'm back in the fix and flip market for reasons which I'm sure Brittany might ask questions, and we'll get into that. But that's why I'm in New Jersey. I do primarily fix and flip. Also looking now and for the immediate future for investment property apartment complexes on the East Coast or down south, which might be more in line for my retirement and might be made available to your, to you, the audience, through Next Generation as that comes up. But today we're talking fix and flips. Thank you, Brittany. Erica.
All right, so let's jump into some questions, Steve. So for the audience, we are going to, of course, we're talking about passive real estate investing through short-term fix and flips. That's sort of our focus for today. And in the registrations that we saw come across, a lot of the individuals just mentioned that, hey, I'm looking for more investment opportunities. And I think, Steve, you can probably speak to some of the trends you've seen in the market over the past year and a half, or of course the pandemic, and how that's presented some challenges for finding deals. And it sounds, the tone that I got from our audience was, I want to do this, but I'm trying to find some opportunities. And especially when it comes to using a retirement account or an IRA, passive type investments tend to fit really well. So you've been in the business, as you mentioned, for quite a few decades. So why do you think that real estate is a more attractive investment option as opposed to just sticking in the stock market?
Well, I've always viewed the stock market with a very critical and pessimistic eye. In my mind, and my wife and I are not invested in the market now. She was when she was working. She's retired right now. I find the stock market and all the mechanisms behind it, all the digital possibilities of getting involved in it, the big institutional investing, I find it a crapshoot. You can see the market go up and down 500, 700, maybe 1,000 points in a day. And until 2008, we really never saw that happen in real estate. And even in 2008, the horrible crush, the loss of value, the loss of credit, the loss of funding, it still took a matter of months. Right now, and over the past year and a half through COVID, what has happened in the real estate market is a conflagration of a couple of things. Over the last 7 years, people probably know that these real estate shows on cable stations like HGTV and other stations on cable have proliferated. And there are so many shows and new shows coming all the time talking about flipping. And flipping is a legitimate and a legal and a very good way to get involved in real estate. It's not for everybody. The market recently, particularly during COVID, has been very, very, very difficult. And this is why. During COVID, we suffered, and we are still suffering in many parts of the country, rent moratoriums and foreclosure moratoriums. And nobody wants to see people evicted or people lose their homes at any time. But when that happens in the normal course of events, there are always millions of foreclosures on the market every year. And of those foreclosures, there's a wide market for any number of people or institutions. But what's happened over the last year and a half is really amazing. Zillow and other companies like Zillow during the last year or so have purchased 15, 20, 22, 25,000 homes just based on algorithms. They are currently, as I read and hear on the business networks, they're currently trying to dump some of that property, even for less money than they paid. That was happening at the same time that we had COVID, the same time we were having moratoriums, and the same time where so many people watching these TV shows have thought, wow, I can make a lot of money and I can make it real easy and I can make it really quick. I'm going to go flip a house. That's what's been happening. All of those different factors, along with incredibly low interest rates, which is great for real estate. So that's where we are today, Brittany. That's what the market is today. And there is really a tremendous shortage of properties to be purchased, either foreclosure, pre-foreclosure, estate sales, probate, any of those deals that we in the industry call distressed properties, either financially distressed or physically distressed. And right now, it's a lot of people with a lot of money pursuing not that many properties, but it's beginning to change.
And just a quick follow-up, do you expect that we'll see some sort of a pop soon when these moratoriums, more of these are expiring, and do you expect we'll see a lot of foreclosures, just sort of like a burst of them?
Yeah, well, that might be the right word for it, Brittany, because the national moratorium, wherever it exists, is supposed to expire January 31st, 2022. Interest rates, although very low right now, because of the current inflationary trend and the inventory chain supply problems around the world. There's just so much going on. There's a lot more talk by the Fed of beginning to raise interest rates sometime next year. There's a lot going on, but I think the simple answer is in 2022, if the moratoriums are lifted immediately or gradually, and whether or not interest rates begin to climb or they don't, that won't have a big factor in my business. I think the market will open up. If the moratorium ends quickly and there are no protections put in place by the cities or the states regarding foreclosures or people who have not been paying rent, there could be a burst. There could be a balloon burst of millions of property hitting the market within a short, period of time. But I think everybody out there has the ability to watch, Fox News, CNBC, Yahoo, Bloomberg. You'll know what's going on. Nothing's going to happen that's going to surprise anybody, really. And I'm hoping and I believe this market will be opening up in 2022 and be incredibly strong with many more properties to buy. That's the way it looks right now.
Okay. And in anticipation of those opportunities, we know there are lots of different types of real estate investing options, right? Today we're talking about passive, we're talking about flips, we're talking about short-term flips. I mean, even within passive investing, there are different types of approaches and different types of strategies. So I know we're gonna get into that, but for those that may be not quite as experienced with all types of real estate investing, are there any terms, or I know there's so many acronyms too, like ARV and CMV. Can you talk to us about, can you define some of those for us before we dive into the details here?
Sure. I wanted to make as inclusive a list as I could for today. Even terms that I may not use all that often, but they're basically terms of the industry the real estate industry, but certainly people that do fix and flips or fix and holds, which we'll mention later on. So here are some of the terms that I can define them now, or I can define them if we got a question about them. But a PP is a purchase price. An SP, and these are things people will see on listings or offering statements or something that I might send to a prospective investor, indicating what these particular numbers on the paper are. So these are things they would see. SP is a selling price. CMV, current market value. REO, real estate owned, and that's typically a property, usually a single or two-family, but it could be any real estate entity, property that's owned by a bank. REO, real estate owned, and typically real estate owned by a bank or a big corporation. There's also ARV, as you mentioned, after repair value. LTV, loan to value, percentage of a value of a property that a lender might be willing to lend for a mortgage or for a loan. FMV, fair market value, and SFR, which used to mean single family residence, but nowadays I see it used more as single family rental. So either way, single family rental, a one family home that somebody might buy, rehab and rent out, or SFR, single family residence, a single family home itself. And those are the more common daily terms.
Okay, thank you for that little bit of background. Can you talk to us a little bit about what attracted you specifically to the flipping business, and if there's anything to add regarding why New Jersey? I know you did provide a history of your background and sort of what kept you in New Jersey. But for those who may not have experience investing in New Jersey, is there anything they should know about, why it might be attractive to them?
Sure. We're lucky. You work in New Jersey. I live here in Manhattan, and really any area, geographic area within an hour, 2 hours of New York, of Manhattan, the business district, the financial capital, is generally a good area for real estate. People want to live as close as possible to the centers of culture, entertainment, finance, jobs. Now that's changed the last year and a half because of COVID. So there is going to be, and there is happening now, a major adjustment in terms of commercial property. Office buildings may not have the value now or in the near future that they've had in the past. I wound up in Jersey, as I mentioned to you, because my first partner was from New Jersey. And I stayed there because I was making the trip out to view one property. Why not make a trip out to view 2, 5, 10 properties? So I like to work in the same area just to save time, particularly commuting time. It's not easy getting out there. It's not easy coming back, but it's easier for me because I'm going against the rush in the morning to get out of Manhattan. And then I'm coming in, not so much of a rush coming in at 4, 5, 7 o'clock at night into Manhattan. New Jersey is a great market. It's a great bedroom community. It's got jobs. It's got a high density of population. It's got good transportation. It's got many great bedroom communities and transportation to get to and from them to the city and back, because of the different train lines there. But there's also upstate New York, Westchester, Long Island. Anywhere around here is probably in general a good area to invest. But New Jersey, to me, it's always been that affordable, that reasonable, that nearby, that picturesque, that historic area where people always want to be there. With all the problems and all the jokes and everything else about New Jersey and the taxes, people want to live and work and travel into or through New Jersey. It's always been a good market for me. Is it the best? I don't know. Ask 100 people who are buying property in the metro area, and I'm sure you'll get 100 different answers. But New Jersey has worked for me. I'm not obligated to it. If an agent or an attorney calls me with a particular deal, and I feel I can make money and handle it properly, I'll go see it and grab it, whether it's Long Island or upstate. If I can realistically do it, I'll do it. But everything is right there in New Jersey. It's worked for me and the people who have invested with me in the past, and I hope to continue that and have it grow.
I agree. Sometimes New Jersey gets a bad rap. I did my undergrad up in Boston, actually, and I lived up there for a while. And I remember all the kids would always joke, like, "Oh, you're from New Jersey. Like, it's so smelly and like dirty there." But it mainly because if someone hasn't really spent time in the state, they've mostly just driving down the turnpike. That's what you're going to see. And I
Yeah,
actually remember I actually wrote a persuasive essay in college on debunking some of these stereotypes about New Jersey, and it was very eye-opening to find, there's a lot that the industry produces out of New Jersey that the entire country benefits from. So
absolutely. Yeah,
I hear you on that. But
yeah.
anyway, let's shift gears and let's dive into the mechanics of short-term fix and flips. So how does it differ from other real estate investing approaches like buy and holds or other types of
Well,
income property?
okay. The goal of a fix and flip, and the concept that I entered the industry with 34 years ago, is that you buy a property, I buy a property, I fix it, and I flip it very quickly. I've come to learn that the general guidelines are the property is going to be purchased for cash. There's no getting a mortgage. There's no contingencies. When you're looking to buy, whether it be a 1, 2, or 3 family, all of which I've purchased, you have to buy it with cash. You have to buy it with no contingencies, and you have to close quickly. Because again, these properties are typically foreclosures, but even if it's a pre-foreclosure and you're dealing with the owner and the bank holding the mortgage, or an estate sale, which could be a foreclosure, or a probate, uh, in any and all cases, the sellers are not going to wait for you to go through the machinations of trying to get a mortgage conventionally. And you're not going to get a conventional mortgage on a typical foreclosure, because typically there's enough damage or enough deferred maintenance that the property is not fully habitable or would not qualify and get a current C of O for occupancy after the current people move out. So keep it simple. Uh, Foreclosures need to be purchased with cash, which is where your clients come into my industry. I borrow the cash from other people. I buy the property for cash. I do the rehab immediately. I hire contractors, qualified, insured, experienced contractors. I usually find the contractors in the towns where I buy the property, because those contractors tend to be more familiar with the permit structure in that community. They might know inspectors, so it might be easier to get an appointment, to get an answer, to find out, how to get things to happen quickly, all within the law, no shortcuts, but just knowing the laws and knowing what each town requires just makes things a lot easier. And when you're fixing and flipping, time is your enemy. So for my purposes, my fix and flip is we buy it, we fix it, we give it back. I give it back to typically the agent who sold it to me. So they get another commission on selling it from me, and they sell it a smaller commission they receive selling it to me. And that's why they will bring deals to me. Of course, I respect them for that. We sell it as quickly as we can. The closing attorney will send the check to, let's say it's one of your clients, cut the check at the closing, goes immediately back to the entity, the self-directed IRA, with a profit, be it interest or a piece of equity, whatever is negotiated, and the deal is done. Always within 12 months. A fix and flip definition is it's done quickly, always within 12 months. My mortgage notes to the investors are 12 months. After that, they have other options. But typically, when I was doing it more actively before COVID, and even as it's begun slowly now, typically properties now are selling ever so quickly because there's such a shortage. And this has been all over the news for several months. So right now, a decent house, fixed up very nicely, getting all the permits, the C of Os, everything else, and in the market where we are, any reasonable place in New Jersey, it's going to sell in days, if not weeks, and that's the goal. Get it sold as quickly as you can. Get the money back to the investor. The whatever's left after the investor gets their money, I pay the expenses, I pay any liens, taxes, water, sewer, whatever. All that's paid. The rest becomes what I've earned by doing the deal. And right now, I'm only interested in making quick cash so I can assemble a pool of cash to be able to buy a couple of apartment buildings or complexes over the next 3 to 5 years for retirement purposes. So I'm interested in fix and flips because it raises a lot of cash and quickly, and you can just redo it, redo it, redo it, redo it.
And you mentioned a couple of things too that tend to bode well for investors using IRAs. One, buying properties in cash tends to be a lot more straightforward with an IRA. And two, not necessarily going the route of a conventional mortgage. And that also tends to bode more conveniently for IRAs, as IRAs typically, when getting into a deal, cannot take a conventional mortgage. If they need to leverage, they need to be through a non-recourse loan. So those features tend to take some of the extra kind of work out of the process when IRAs are involved. And when you're doing these deals, how do you typically structure them? If you were going to work with investors using IRAs, for example, would they be sort of partnering with you on the deal where they would have a percentage of ownership of this property, or would they be investing more as like an equity investor into an LLC that you've created, or would they be lending money? Can you talk about some of the options that are available for the structure?
Sure. I always form, whether I'm investing with somebody who has a self-directed entity or not, I always form LLCs, limited liability companies. Sometimes my attorney might recommend I purchase the property with a trust, but that's few and far between. Typically an LLC, and the investors, any investors, your clients or any others that I do business with, they are not, unlike some other companies that may do this and may work with your clients. Your clients would not be a partner or an equity holder in a deal with me, and that's really because it protects them from liability, insurance liability, if anything happens on the property. Number one, and number two, they don't have any questions with the IRS as time goes by. Those are questions, of course, you and I will refer your clients to talk to their accountant, but there are certain types of deals that can be done that, where you're running a business within a business by doing a deal like this, and then your clients might have a question with the IRS. There is no such question, problem, or gray area when your clients are loaning my LLC the cash to purchase and or rehab a property, and I'm giving them a mortgage note in whatever name they want, and I am running the property. I'm running the deal. I find the property and I close on the property. I find the contractor. He and I pick the colors and we pick everything going in the property. This is not anything that your clients need to be concerned about. They're not going to be involved in the day-to-day. They'll know the property. They'll be able to go to the property. They'll be able to see the property any day. They can come to the closing when I buy the property. They can come to the closing when I sell the property. There are no secrets. It's just for their safety, business safety and liability. They simply are not going to be involved in active management. This is a passive. I'm sure you'll talk about this later, Brittany. This is a passive investment. It meets every definition of passive for your clients, where they're not doing anything in the management. They're my bank. They're basically a bank for me. And because they're a bank for me, when and if they choose to do a deal with me, I pay all the expenses. There are expenses associated with transferring their money from a current fiduciary to your company, for example, or contract drawing. My attorney will draw up a contract, mortgage note. I'll send it to your clients. If they want to have an attorney of their choice review it, I pay for it because, again, they're my bank. They don't pay anything. I pay the fees, and it's a great setup for them. They don't have any incidentals. They never come up with any more money than what is borrowed at the beginning and covered by a mortgage note, and they get paid first when the property is sold.
Yeah, so you're right. We will get into a little bit more of the mechanics in investing with an IRA, but to your point about it being strictly passive, with the IRA, it does make things a lot easier from the perspective of an investor not worrying about prohibited transactions, right? When we talk about doing things like sweat equity on a property, that's not allowed when your IRA owns it,
Right.
or performing other sorts of tasks that might add value directly to it, which are not permitted for the IRA holder to do. It just takes all of that kind of guessing out of the equation with a truly arm's length passive investment. But it's also good to know, as you mentioned, that there is some level of transparency. So if someone's giving you their funds and they want to be hands off, but they also still want to have some insight into what's going on with the project or the status, or they still have some exposure to that.
Yeah, absolutely.
One other thing I wanted to ask you was, can an investor enter into multiple deals at once if they wanted to do
Yes.
that?
Yeah. What I like to do is to get one investor, one of your clients, one investor into one property at a time. But the law permits, the IRS and the law permits now, if, let's say, a client of yours gets in contact with you or me after the webinar, and they want to invest, and they don't have enough money for a particular deal to buy it and rehab it, and of course pay the closing costs, which they also loan me. The IRS permits me to borrow from as many as 2 people at one time into one entity, but no more. Because after that, if there are 3 more people, it becomes what they call pooling resources, and you're getting into syndications and group, crowdfunding, and it's a whole different ballgame. But the simple answer is, I can have 2 different people loan me enough money to buy and fix one property, and the person who loans me the most money would get a first mortgage and mortgage note. The person who loans me let's say the rehab money, of a lesser amount typically, would get it would be a second mortgage. They would be in the second position, but still getting paid at the closing. As far as multiple deals, if any of your investors, your clients, have enough money and they want to invest in 2 deals simultaneously, yes, they can. It would be a separate LLC. It would be a whole separate deal. And on my end, I don't see any problem. I don't believe I've ever had one with the IRS in the past with anybody that may have come, through a self-directed. This is something, of course, on your end, your legal people would be able to talk with your client about it. But I believe that that's perfectly legitimate, doing 2 or 3 deals at one time, each one being separate entity, and all under, the IRS requirements that we previously spoke about.
Yeah, as long as there are no prohibited transactions, in and of itself, investing in multiple deals with the same entity does not present a problem. And from our perspective as a custodian of the IRA itself on our books, in terms of reporting, for example, if someone were to invest in 2 different properties with you, then they would have 2 assets owned within their IRA. One would be an investment in ABC LLC, and then the other would be an investment in DEF, for example.
Yes.
So It's pretty straightforward, and obviously reporting and valuations are completely separate on the 2 assets. Last question for you. I think you already mentioned this and you talked about it, and it's pretty straightforward, but are there, in terms of how investors profit from this type of investment, passive short-term flips, are there higher earning potentials than other types of real estate investing options?
Yes, I'm glad you brought that up. I'm glad you had time for that question, Brittany, because one of the primary reasons that people have invested with me for all these years and invest with other people that do what I do. One of the reasons, aside from getting your money back within a year, typically, is that you will make in most cases returns that are almost impossible to make unless you're a professional money manager on Wall Street, or unless you're an entrepreneur and you own your own company. I mean, we typically pay an interest rate. It varies. It can't be. I can't discuss the specifics with you, but I certainly can if any of your investors get in touch with me or are interested. I can certainly tell them specifically. But interest rates in the banks right now are a point and a half, point and a quarter for a CD, a 0.75. I mean, we always have, and we, for the immediate future now, can pay much higher rates, double-digit rates back. And why? Because if we're doing our job properly, I buy a property very cheaply. I make my profit when I buy the property. I realize my profit when I sell the property. In other words, I buy it so cheap, I put in the rehab to bring it up to value. We then sell the property. I don't know if any of the hundreds of deals I've done going back to the late 80s has ever really been affected by appreciation, the natural increase in value that a property may have in terms of improving it, painting it, rehabbing it, having time go by and values in the neighborhood go up. And people like me, people who do this fix and flip, they buy the property at such a proper and below market price for the property in its current condition. They then add value by renovating it, whether it be cosmetic or a major renovation is possible. And then they sell it. We try to sell it at or just below the market value, so we get a quick sale. And doing all of that right, I make my profit, as I said, when I buy the property, and I realize it when I sell it, pay off my investors. There's money left for me. That's when I actually realize the profit. But if I'm doing it right for me and the investors, I'm buying it properly. And double-digit returns are a common thing for others as well as myself to pay back easily.
That makes sense. And of course, we're not promising any or guaranteeing any investment returns here,
Right.
but double-digit returns tend to be more expected with real estate investments in general. I would think that's safe to say, and certainly tend to outpace what people are getting in the market over long periods of time.
Yeah.
So going back to the point about alternative investing as a diversification strategy, of course, it's not necessarily meant to replace any investing in the stock market altogether, but investing in alternatives have been found to yield more stable returns over a long period of time with less volatility. So that certainly ties back to just the whole financial planning, retirement planning aspect as well.
Yeah.
Thank you.
When something happens with a real estate investment, good, bad, or indifferent, the owner or the developer or the sponsor like myself, at least I can point to something and I can say, this is why it happened. We had a leak, a pipe froze. We had a problem. We had to go back in. I had to go into my pocketbook because I never go back to my investors for money. I had to go into my pocketbook to fix something that occurred before the property sold. I mean, in real estate, you can see, you can show somebody, they can touch why something is happening. And again, although the stock market is so terribly important, and so many millions of people in the country are invested, as most of your clients are, And I guess there's a place for the stock market and bonds and everything else. There certainly is in a balanced portfolio. Uh, in the real estate, it's something that typically you can touch, you can see, you can understand. You can understand why the values go up and down. There's nothing, if the market goes down tomorrow 600 points, why? You'll hear 100 people give 100 reasons on CNBC, but why? My value went down just like that overnight, 600 points. Of course, it'll come up in the long run. And the market's a great place to be long run, but uh, I just love the real estate and every aspect of it. The apartment buildings, which I'm shopping for the future, it'll be active income for me. I'll be managing the property or hiring people to manage it, but it will be monthly income for me and my wife as time goes by. These deals are great for anybody who wants to raise cash as often as possible and get the bundles of cash. In my case, to pull away for retirement, to buy apartments, and probably for some of your clients, realizing money goes right back in the IRA, and they can just build that IRA, wonderfully build it over the years with these returns going right back in. So, not to be not to kill a dead horse, but kick a dead horse, but really such a difference. And every investment has its pros and cons. And fixing and flipping, really, you want a lot of money, you want to get it back quickly, you want to know where it's going, what it's doing, and that's what we offer.
That brings us to a very natural segue into talking a little bit more about the self-directed IRA as an investment tool. So I know that you mentioned having some questions for me about that, and I'd be happy to share some more insight for our audience.
Okay, yeah, I would, because I've only done, maybe 100 or so of the deals I've done in the past have been with investors doing a self-directed entity. Most have been private investors, but yeah, I really do, Brittany. We covered a lot here today, and I wanted to switch gears and talk about why self-directed IRAs. Basically why and how long have they been an entity that people could look to actually control more of their destiny with a financial instrument.
So surprisingly, they've been around since the inception of the IRA itself in the 1970s. And it's still pretty amazing to find that even some of the most sophisticated investors today either do not have experience with self-directed IRAs or they're not aware of them. I think today there's a growing awareness, but the level of knowledge and education about them is still not quite always to the point where someone would be confident enough to actually pull the trigger and open one and use one, because there are a lot of questions and a lot of things to consider. And we're talking about retirement funds, so no one's going to jump in without really doing their due diligence on the strategy. And I think we found that maybe perhaps one of the reasons that this is still not as widely known is that the large banks and brokerage houses like the Fidelities and Schwabs of the world do not specialize in holding these types of investments in IRAs. They would prefer to be more focused on public securities and the stock market, and that's what they do very well, and they make a lot of money doing it, so they're probably happy to continue being the go-to source for those things. Conversely, we are specialized in only holding private alternative assets in retirement accounts. So there's a specialization, but most custodians that do this are not as big as the Fidelities and Schwabs of the world. So, we're not advertising on television as much as they are, and we're not, we don't have the marketing budgets to be out there doing as much as they're doing. So little by little, though, we do try to share this education as much as we can. And we talked about some of the features and benefits of self-directed IRAs that make them unique. The ability to have more control over your investment returns by really being able to go out and pick, what property on this street you want to invest in. So you really have the power to do your research and do your due diligence on a specific type of investment or asset and say, hey, I think I'm going to get X return on this. I feel pretty confident about that. And I want to put my money into something that I know and understand, especially with real estate. It's real, you can touch it, you can see it, versus you're investing in the stock market and you may a lot of it is luck and good timing and, just making judgment calls on things. And we don't necessarily, especially with minority stakes in some of these large corporations, we don't have much control or much say. And then, as you said, all it could take is, somebody putting something on Twitter for stock to tumble. And we just kind of cross our fingers and hope that doesn't happen. So self-directed IRAs don't work that way, obviously. They were more focused on things that tend to be more stable. Of course, the investment returns are going to be tax advantaged as well. So there's the ability to generate these earnings that if you don't necessarily need them in the short term and you want a long-term wealth building option, a self-directed IRA is going to give you that because your earnings are either going to be tax deferred, so you don't have to pay tax until you decide to take money out at retirement, or tax-free if you have an account like a Roth IRA that you're self-directing. So there are a lot of financial benefits, potentially long-term.
What are some of the no-nos as far as self-directed IRAs?
So the two types of investments that are not permitted at the highest level, and of course this is all regulated by the Department of Labor and the IRS. The two asset classes not permitted are life insurance and collectibles or antiques. So things like old like baseball card collections or a wine collection, things like that. But outside of that, a lot of things can be invested in as long as they're not publicly traded. The other no-nos or restrictions really relate back to who's involved in the investment, what is their relationship to the IRA holder, and then who is benefiting directly or indirectly from the investment. So the IRS has a list of what they've defined as disqualified persons that are not permitted to do direct investment transactions with the IRA itself, and that would include the IRA holder. So if you, Steve, had a self-directed IRA, you wouldn't be able to invest in one of your own deals with your IRA. It would also, disqualified persons would also include any spouse, ascendants, descendants, or their spouses. So children, grandparents, grandchildren. There are exceptions that are not considered restricted, like siblings, aunts, and uncles. So the ones that are restricted, if you think about your family tree in a lineal fashion, like an up and down structure, those are the relationships that are not permitted to do direct investment transactions with an IRA. And then additionally, when we talk about who's benefiting or how value is being added, we mentioned earlier that sweat equity is not permitted. So any of those disqualified persons would not be allowed to do physical work or repairs on a property that's owned by the IRA. So when we think about it, that's why we say that a sort of more passive arm's length type transaction tends to be an ideal fit for an IRA, because there's not as much chance to even accidentally do something that would be considered a prohibited transaction by the IRS. But of course, we provide a lot of education on that, and if we're talking to a specific investor and they have a specific scenario in mind they would run a run by us, our compliance team could certainly take a look at the information and make a determination for them.
Well, that was the last question I actually wrote down for you, Brittany, because I was curious. How would somebody, how would they go about it? How would they go about setting up a self-directed if they haven't got one, or they're not even the client of yours? And then what documentation is involved on your part, on their part?
Sure. So if they've never set up an account before, we want to have a conversation to, first we want to get an appreciation for what are they looking to accomplish? What are their objectives? Do they have a specific investment in mind? And then we also want to have a discussion about different account types, because even within the realm of self-directed IRAs, we have traditional tax-deferred IRAs, Roth IRAs. For business owners, we have SEP IRAs, simple IRAs, even other types of qualified plans like solo 401ks if someone owns their own business and has a 401k plan. So potentially all of those types can be self-directed. So before someone sets up an account, we have to have a conversation about what account type do they want, and if they're not sure which is his best fit, it's usually good to discuss that with their tax advisor. But once they've made a determination about the type of account that they'd like to create, we also have a conversation about how are you planning to fund that account? How are you going to get cash in so that we can deploy it for your investment or investments? So then we tried to get an understanding of, do they have existing retirement accounts, like perhaps an old 401k that's no longer active that could be rolled over into a self-directed IRA, or if they have IRAs at other institutions that don't allow, for example, real estate investing, like Fidelity or Vanguard, they could transfer some or all of the funds from the other IRAs to their self-directed account. So we work with investors through every step of the process to get the account set up, get the funds moved over, and then to your last question about what types of documentation are needed, depends on the type of investment and how it's being structured. So if they are investing directly into a piece of real estate, something we'd need would be the purchase agreement. And then we would also need a copy of the recorded deed once it's available, so that we have proof of the asset. And we would obviously hold that on our books, and it would be titled in the name of the IRA, not the personal name, so that it does have that tax advantaged identification for the IRS, if you will. If they're going to be lending, and it's going to be a mortgage note or a promissory note, then we would want a copy of that, along with, if it's going to be secured by anything, we would want to know, what that security or that collateral would be. If it's going to be more of like a private equity type investment, if they're investing in an LLC, for example, and they're going to have some ownership, any sort of a partnership agreement or any documentation that they would typically sign to invest with someone like yourself, for example, that would have to be in the name of the IRA, and we would review that for compliance, and then we would actually sign off on any of those documents on behalf of the IRA. If they're investing in a private entity or company like an LLC, we'd also want to take a look at the operating agreement so that we can understand who are the principals of that company and where is it located and how long has it been around. Just because those are things that we keep an eye on if needed. And of course, our main motivation is to protect the tax advantage status of the account. So from a reporting perspective, we make sure that we do all the record keeping, tax reporting, and administration for the accounts. And if any monies are moving in and out, that are being coded properly for tax purposes. As Erica mentioned in our disclaimer, though, there is some onus on the IRA holder or the investor to still do their due diligence on the investments that they're choosing.
Sure.
They do assume whatever risk is involved with that investment. So we don't guarantee any investment returns or any investments from that perspective. But from the perspective of a financial institution, we have certain responsibilities that we have to uphold, and we are a trust company, so we're regulated and audited by the Banking Commission, and we have certain obligations to them on a regular basis as well. So that process of opening the account, funding the account, reviewing the documents takes several weeks. So I know you mentioned earlier, it's competitive out there more than ever now, but even in general, real estate deals move fast. So if someone had a thought that they might want to do something, it would behoove them to proactively establish an account, even if they haven't identified a specific investment yet, but it would be wise to at least have the account set up. We don't have a requirement for them to fund it in a specific time period. So even if they had to wait several months to find a deal and then move the funds in and provide the paperwork, that's fine. But at least they're a few steps ahead in terms of having it set up. So we do try to have that conversation in advance and set expectations on that, because I think the conception typically tends to be that, oh, I'm so used to, my Fidelity trading account, and I just press a button and I can trade stock in a matter of minutes. This is a little bit of a different model, right? And we're looking at alternative assets that are, every single one is unique and different. So we don't often see two of the same ever, which is great, but that just means that there has to be additional time allotted to the proper review and the proper channels to make sure that we're being diligent about things.
Right. Yeah. Well, those are the questions I had basically for you. Great job explaining it. I would just emphasize that timing. I'm sure people have heard the expression "time is of the essence" in real estate, as you just mentioned. That is so true. And in my business, in my industry, it's truer than most. So if anybody is interested in setting up a self-directed now or in the future, they really should get in touch with you or Erica and at least get the ball rolling, at least have that entity, because there's even a little time involved once I present them or they're presented with an investment opportunity and they say, yes, I want to do it. There's still a little bit of time in terms of getting that deal funded on my part. So I would urge anyone who's interested, call you guys, talk about it, at least get the self-directed entity going, and then they're under no obligation. They can take whatever comes as an investment. They can look at the myriad of possibilities, but at least they're in the position to do something with you.
Yeah, that's a good point. They're yeah, under no obligation, and the beauty of it being self-directed is it's completely up to the investor. You know, what they'd like to do, how much money they'd like to start with. There are no minimums. No one's going to try and push them in any one direction. And it's completely up to them to have the freedom to choose for themselves when and how they want to do it. Yeah. Well, thank you so much for your time and expertise, Steve. Hopefully this was helpful to the audience in terms of thinking about whether you have a self-directed IRA and you're looking at different investment options if you want to add to your portfolio, or you don't have one and you want to get started. Some things to think about and consider. And of course, there's a ton of information available at nextgenerationtrust.com if anybody wants to do some more self-educating or even talk to someone at the office. Erica, if you're still out there, I don't know if we have any questions. I know that we had a couple polls that we wanted to try and run for the audience to just get a sense of where they're at with things too.
Yes. We do not have any questions that I can see. So I will get into polling, but before I do that, I just wanted to let everybody know that if you'd like to get in contact with either Brittany or Steve, I put their contact info into the chat box, so you can grab any of their contact info from there. But to push things forward, before we wrap things up, I do have a few polls just to try to get to know you guys a little bit better. So the first thing that we'd like to know is what type of retirement accounts do you currently have? So I'll get that out there right now. Okay. So we'll close that one out. I'll share the results. And we've got most people either with a traditional or Roth or some form of employer-sponsored plan, which is pretty typical. So moving on. And this one is obviously, if you're comfortable sharing, what is the balance of those retirement accounts? Okay, I'll close that one out. Let's see the results. So a good healthy number, that's good. There's a lot that you can do with that. And then our final question, what types of investments are you currently interested in? Okay. And no surprise here, we've got 100% for real estate, which is probably what brings you here today. So with that being said, thank you guys for joining. We will get the recording out sometime tomorrow, and we look forward to seeing you on the next one.
Thank you, Erica.
Thank you, Brittany.
Thank you,
Thank you,
for the
Steve.
opportunity. Thank
Have
you.
a great day, everyone. Be safe.
Okay.
Bye,
You
guys.
too. Bye-bye. Be safe.
Bye.